What is this amalgamation? What is internal reconstruction? What is capital reconstruction? You understand them gradually. Our focus right now is only on your amalgamation. And that is what we'll be starting up straight away. Amalgamation, straight away guys. Amalgamation is most important in group 2 and relatively less important idea in group 1. Most of the examination questions in group 2 are from amalgamation. Most of the examination questions in group 1 are from internal reconstruction. Then distribute 9 record. Out of 10 questions, 6 or 7 would be internal reconstruction in group 1. Exactly opposite in your group 2. The other 3 would be the next idea. What is amalgamation? Any input is? What exactly is an amalgamation all about? Corporate entities? That is what it is. Two or more entities will become one. That is what we call it as an amalgamation. So amalgamation implies that was at the end of this entire deal, you will find there is only one company left. What about the other company? I just mentioned. So before, after. So before we can have A limited and B limited, after we'll be having only A limited. Before we can have A limited, B limited, after we'll be having some new company called as C limited. All are amalgamation. So whenever we have any deal about amalgamation, we are looking at what? At the end of amalgamation, you will be having only one company. So amalgamation can result in one existing company taking over one or more other existing companies. Or alternatively, it can also result in one new company taking over two or more existing companies. You're able to follow here? Amalgamation can happen not just between two existing companies, as in like there is always a buyer. The buyer need not always be an existing company. Buyer can always be also be a new company that is being formed. So you are running a business called as A and Co. I am running a business called as B and Co. I come and tell you that B and Co will take over your business. Let us do this business together from tomorrow onwards. Amalgamation. Both of us come together, create a new entity called as C and Co. That is also called as amalgamation. That is what it is all about again. So when we start dealing with amalgamation, do watch out for these small specific points. Common misunderstanding is that people deem only the second case as amalgamation. People ignore the fact that first is also an amalgamation. Rendume amalgamation. This is also amalgamation. This is also amalgamation. Both are amalgamation. Please be very, very clear. Don't understand that two companies forming new entities amalgamation. It's not that way. Two companies becoming one, the amalgamation. Clear, guys? Everybody here? Yes? So what exactly is an amalgamation? This is what an amalgamation is all about. Ultimate concept being, at the end of amalgamation, only one company will exist. What about others? Pudu company mulingirum. So whatever new company that you are going to form, or whatever be the buying company, would ensure that all the other companies are being totally taken over. So implication being, all the assets and liabilities of the so-called selling company would be taken over by the buying company. The so-called one remaining company. This is what we'll be dealing with, guys. Yes? Next. So when we start dealing with amalgamation, we start focusing on amalgamations kind of accounting. Accounting for amalgamation is driven by AS number 14. Accounting standard number 14 deals with something called as accounting for amalgamations. And that is what we'll be adhering to. I just mentioned a very, very critical point right at the outset so that we can be clear about this. Amalgamation is between two or more companies, out of which one will be buyer and the others would be what? Deemed as seller. right? AS 14 is applicable only for accounting in the books of buyer or seller. Why? Selling company will not exist. Saha or a company ki accounting panna and a panna tell. That's the reality. The company is going to no longer exist. Why do you really need to bother about which accounting side is applicable? You're able to follow the point again. So whenever you're dealing with AS 14, keep it in mind, you're primarily applying AS 14 only on the buying company. That is what the point is all about, guys. Watch out, please. Chaliye, guys. Yes? We'll straight away hit this particular point. Once you start looking at AS number 14, you will realize that accounting depends on something called as classification of amalgamation. AS 14 classifies amalgamation into purchase and something called as merger. AS 14 categorizes or classifies your amalgamation into either purchase or alternatively merger. So entire concept relating to your accounting would start only with this small little idea called as what exactly is purchase, what exactly is merger, and then we will understand what exactly is the implication of these two ideas. So the three journal entries will change, but it does have huge amount of implication in terms of the entire accounting business. Having said that, only in India, you have this merger and purchase and all these IFRS and abroad accounting standards, you'll find that no such distinction is taken, is being given. And by the way, happy news for you all guys. AS number 10 and AS number 6 is up for replacement by a new set of accounting standard, which was draft was issued, I think somewhere around the time when I was a student. So it is still there. The same draft, after making some further correction, these fellows have brought in, will not be applicable for your May examination. That is my point that I am trying to say. Once you start going to that glorious temple called as CAClubindia.com or that other fantastic place called as Facebook, you will actually find that all Gyanis of this world will come out and tell that AS 10 is going to undergo huge amount of change. Latest I should study. You can study the latest one, but then you should be waiting for your latest examination. You will be keeping on writing the examination till the latest idea has been tested. Don't get near that stuff as on that. If it is actually made applicable or any changes happening, I'll be the first one to come and tell you. So don't worry at all. Don't even worry. Somebody is coming and brainwashing you that learn the latest for the examinations. Please. Then you will always be the latest student. So let's go beyond that stuff. So amalgamation is classified into purchase and merger. Watch out for this idea. What is purchase? What is merger? We'll hit that, then start solving some questions. What is the distinction between purchase and then merger? Equal. Yeah. You're going to say that case A is purchase and case B is merger. Then the dominance, that example you are using, anything that we need to incorporate in AS 14. Yes, please. Follow this point. The idea is something on control. I'll tell you how the entire example happens. Let me give you two scenarios. One of these scenarios is deemed as merger, the other scenario is deemed as purchase. Let us say that you are doing some business, I am doing some business. And I come to you and tell that, okay guys, let us do this business together from tomorrow. Scenario A. Let us do this business together from tomorrow is scenario A. Scenario B. You are doing a business, I am doing a business, I am coming and telling you that, do something else. From tomorrow onwards, I will be doing my business and your business on a standalone basis. You buzz off. Second scenario. First scenario, let us do this business together. Second scenario, I will do this business, you do something else. You're looking at two possible scenarios. You're able to appreciate. One is a purchase, another is a merger. What is a purchase? Second is a purchase. First is a, what's the point of difference? Control. So the idea being, in the first case, you, the seller, continue to own a stake proportionately in the combined entity. Is it not here? Because you are part of the entire running this entire business. Second case, you don't get that kind of control at all. You don't get that kind of stake at all. That is what is the point of difference between merger and then purchase. You are able to follow the concept. After that, we will be having some 5 conditions, and forever, all your life will always remember this pancha condition as the sole determinant of what exactly is merger or purchase. But let us, before we get, I would say polluted by those 5 conditions, we'll focus on the concept alone. What's the concept, guys? Difference is control. So technically the idea being, in merger, the seller continues to own or control proportionate share in the combined net assets. Which implies before merger, let's say your company's assets were 10 crores. My company's assets were 30 crores. Combined entities assets are 40 crores. In the 40, you will be having roughly 25% ownership stake. You are able to appreciate the merger. So what exactly is a purchase all about, guys? In case of purchase, you will find that seller does not own any or proportionate share in the combined net assets. I'll just emphasize on that one. Second case, I can say that entire 40 crore can belong to me, the example that I was making in a few minutes back. Or I will say that out of 40, 38 crores will belong to me, you continue to hold or own only 2 crores. 2 crores is a far cry from whatever you were holding before your entire merger business. And that is what we are required to appreciate, the guys. Just take care of this. So merger, seller continues to own, control, proportionate share in the combined net assets. Purchase is all about seller does not own any proportionate share in the combined net assets. The idea being, the seller technically, in this case, seller loses this ownership stake due to purchase. Loses, don't think that absolutely lost, seller substantially lost also. We'll see all this. This is your conceptual base. For AS14, we identify something as a merger or amalgamation as a merger if all the 5 conditions are satisfied. We list down 5 conditions. We'll go about knocking them off one by one and then proceeding further. Condition number 1. Business of selling company is continued by so buying company after taking over the business of seller should continue to do that particular business. The buyer does not do that particular business. Buyer is purchasing the assets and liabilities but doing a different business. We will not call that as a merger at all. For example, long back, when our country had lots and lots of bottling plants, which were dealing in, let's say, manufacture of sodas, so to say, huge amount of bottling plants were there. And all these lots and lots of foreign companies started coming into picture, and alcohol consumption became a bit more hip and mainstream. You found that lots and lots of this mainstream alcohol manufacturing companies started acquiring huge number of bottling plants. So bottling plants which were originally manufacturing only soda or normal water started becoming bottling plants for manufacturing alcohol. Let's say that you were originally having a bottling plant which was engaged only in manufacturing normal harmless soda, so to say, and I am acquiring your business, and tomorrow onwards I am using that place for manufacturing alcohol. Your business I am closing down. I am not continuing that. Is it not here? This will not be deemed as a merger at all. I am acquiring your business, but I am not doing your business. You are able to follow, guys? There are a number of cases that could typically happen that way. Lot of people acquire a business not to do that particular business, but only to get access to the capital, get access only to those assets which can be used for whatever purposes. In number of cases are that. So just watch out, guys. Classic one would be lots and lots of cinema halls that are being acquired by a lot of people, were acquired by a lot of people in the last 10-12 years. வாங்கிடுவாங்க business அப்படியே amalgamation எல்லாம் பண்ணி, you'll find that those cinema halls that are being acquired are later demolished and end up constructing either marriage halls or shopping complexes or some other kind of places. Amalgamation, yes. Continuing the business, definitely no. I'll do something else altogether. Clear, Ayar? Yes? No, I think probably you'll have something on that on your strategic management, but I'm not so sure about that one. You have this whole logic about brand management coming into picture. Wherein people, in a lot of cases, buy a brand only to kill it. You remember there was a detergent soap called as Super 501? Super 501, 501 solid. I know solid is very famous. Like you have this Arsan soap, 120 soap and all, you had 501 as a very popular detergent bar long back. A lot of people don't know right now. Do you find that 501 right now? It was acquired by Hindustan Unilever Limited and then killed. They acquired only for that. 501 is, I don't know how far it is true. They say that like it was representative of the freedom movement also. It was like, manufactured as a challenge against some British companies. And later the same British company acquired 501 and killed it straight away. Thumbs Up is another example, which Gold Spot, Thumbs Up and all were manufactured with the same company, acquired by Coke. They could kill Gold Spot, which later became your Mirinda, so to say. Mirinda origin was the Gold Spot. And Thumbs Up they were not able to kill at all. Thumbs Up is bigger than Coke itself in India. Only in Tamil Nadu is not very popular. Upwards from Andhra onwards is very popular. They could not kill. In a lot of cases, people acquire not to make it big, but rather to destroy it, use it for some other reason. We'll come across lots and lots of these ideas. Anyway. Condition number 1, business of selling company is continued by business of buying company. They don't speak a word about business of buying company at all. You only tell that seller or a business, you should continue. After I continue your business, can I shut down my business? Yes. Will it be still considered as amalgamation in the nature of merger? Yes. Condition number 2. All the assets and liabilities of the selling company should be taken over by the buyer. Which implies if as a selling company you got like say 10 units of assets and 5 units of liabilities, as a buyer I should take over all the 10 assets and all the 5 liabilities. I cannot selectively pick and choose at all. Concept in terms of first condition, since I am going to continue the same business, I should continue to own the same set of assets. I cannot selectively choose some assets at all. But anyway, look at this idea on a standalone basis. All assets and liabilities of selling company should be taken over by the buying company. Third condition, all the assets and liabilities taken over should be incorporated only at old book values in the books of buying company. I'll just emphasize. Supposing you buy an asset from me, normal cases. You are buying an asset from me, let's say for some 10 lakh rupees, your asset. In your books, you will record that asset at what value? 10 lakh. Supposing I tell you that that asset was carried in my books for 7 lakhs, will it make any difference to you? Will it or it won't? It won't. Because as far as you are concerned, you paid only 10 lakhs for that asset. You will record that asset only at rupees 10 lakhs. This is a convention. But once we come down to amalgamation in the nature of merger, you may pay me 10 lakhs to buy that asset, but in your books, you should show this asset at what price? 7 lakhs. At what cost? Only 7 lakhs. That is what the third condition is all about. At whatever value an asset or a liability was appearing in the books of selling company, at that value I should be reflecting these assets and liabilities in the books of buying company. Clear, guys? Everybody here will be taking over assets and liabilities at what value? The same value as it was appearing in the books of your selling company. There is an exception. I'll come to the exception and all separately. Right? Keep this idea in mind. Condition number 4. Shareholders holding at least 90% of paid up equity capital should become shareholders of buying company. So shareholders holding at least 90% of paid up equity capital should become shareholders of your buying company. Notice carefully, I am emphasizing the word called as only equity share capital. And this particular point is often the reason for a lot of people missing out on marks in the examination while writing it down. Common statement, 90% of shareholders. There is nothing called as 90% of shareholders. It is shareholders holding 90% of paid up equity capital. It is also not 90% of equity shares outstanding. It is 90% of paid up capital, because we will come across instances where under your share capital could be split into shares of 10 rupees, shares of 100 rupees and all. So the idea is only about 90% of paid up equity capital. So watch out for this particular point at a later point in time as well. This is your critical point. So the idea being, supposing the selling company has got say 100 crore rupees worth of equity share capital, of that people who are holding at least 90 crore should become shareholders of buying company. We will see how exactly these ideas will happen shortly. Then, last condition, consideration for the above shareholders should be by way of equity shares of buying company only. Exception in case of what we technically call it as fractional shares can be settled by cash. Again here, let's not worry about this exception or what exactly it implies. Just quickly make a note of this particular idea. As we take up different questions, we'll be able to appreciate all these logics on a sequential basis. Just quickly update this particular stuff. Note print अच्छा पता है क्या? Everybody guys. Now, so when we start solving questions as far as your examinations are concerned, you will find that most of the activity or most of the examination question revolves around one small little idea called as consideration for a transfer. That will be hitting straight away. Please follow this guys. Follow this here. So we'll be hitting some idea called as consideration for transfer. We will link all these ideas to whatever we are discussing till now over a period of time. Look at this idea please. What exactly is consideration for a transfer? The consideration for a transfer represents what the buying company will pay to the shareholders of selling company. You are technically not buying something from the selling company. You are buying something from shareholders of the selling company. Right? Because selling company will not exist. We are buying the company itself from your shareholders. So what the buying company will pay to shareholders of selling company is technically called as a consideration for transfer. Most books refer this as purchase consideration. I refrain from using this as purchase consideration. I will use it only as consideration for transfer. Again, thanks only to a classroom interaction. Purchase consideration students started asking, why can't I call it as sales consideration from seller's perspective? You can use it that way also if you are really interested. And then purchase consideration. No panchayat, we will use a simple little phrase, consideration for transfer. The consideration for transfer is arguably the most important working as far as any amalgamation is concerned. Out here we will focus on what? Consideration would be nothing but value or issue value of shares, debentures, cash, etc. paid by buyer to the shareholder of selling goods. So we are focusing only on the recipient. Focus on the recipient. Recipient what here? Shareholders of selling. So when you start dealing with something about consideration for transfer, always watch out only for the recipient. Recipient should be your shareholder.